So a true leader is something that on the strength is green. So that means this week, his relative strength compared to everything else in the database is in the top 15%. And on the consistency, it's been a consistent winner on the basis of the blended index of the last 10 weeks. So my assessment of it is it's great now and then. And I could swing trade onto that by simply saying investing in that one is simply reinforcing trend following. Could I turbo that intraday or short-term swing? Yes. Why would I want to do that? Because winners keep winning until they stop winning. So that leads me to all of these things that are green and green. Check or hold. Technology, finance, and the Qs are green and green. You know what's even better than them? Mid-cap growth, Russell 2000 growth. Now, the other thing that I like is something that was green on consistency or on strength, and then white on consistency. Why is that? Because if I look back at the last, 10 weeks, most of that consistency score comes from the performance over weeks 2 through 10, right? So this one measures strength, and this one measures consistency. So if I saw something that was green on strength, but white on consistency, think about what that means. That means that this week, the performance puts him in the top 15%. But his performance over the last 10 weeks means that he's between in the most recent one, he's up in here, but over the last 10 weeks, he's only here. So what does that mean? That means his performance in the last week took him from the front of the pack or of the body and then moved him up into the leadership. So you can think of this like the peloton. If we're going that way in the bicycle race, the top 15% are up in here. The bottom 15% are in here. Between average and -1 is in here. So if I can get something that is in this week just moved from the front of the pack and now moved up into the leadership, that's a really positive sign. Would you agree? And remember, he's in the front of the pack on the basis of the blended performance. So this is not just 1 week flash in the pan. This is actually some really good performance. So if I have something that was green and white, it was good, meaning that from the consistency was white. He was in here. He's closer to the front than to the rear. He's above average. And he has been for 9 weeks. So that's good. But now He's great. He just moved to the front of the pack. It just accelerated. So the reason I want to swing trade it is because I want to now think about exploiting new strength. And I just identified a new leader, and that could be short-term momentum. So both of these are ideal. The long-term leader is easy to believe in, and we're just reinforcing the existing trend following. That's not even a challenge. But green and white is even better because it was good enough to be above average, but now it's a current leader. It's now great. Check or hold? Absolutely essential. Now, the rest of this table fills in kind of the same way. Something that used to be excellent is going to be green. It was a leadership. He's always been up here in the leaders, but now this week it diminished and moved back to the front of the pack. Do you see how that is the sign of starting to lose momentum? It's starting to decay because it was great and now it's just good. Now, maybe that is a buy on dip opportunity. Maybe. That's not bad. So if it's a buy on dip opportunity, what I'm betting is that the strength of the trend, the long-term outperformance as measured by the green on consistency, is going to overcome the fact that it weakened and came back here. That could cause guys to buy on dip. So white and green was great. Now it's just good. So I want to do two things because yeah, this might do this, but it also might do that. Check or hold. Because this is in a compound critical state, I want to make sure that my stops are in place to preserve profits. And maybe I've already taken profits because of whatever trailing stop I had on it. I'm not going to use this indication to say it's time to get out. But what I'm saying is you want to make sure that your stops are in place. And if it's time to sell, that you sell by respecting the initial stop that you put in. And what I'm going to do, though, is I'm going to watch for a resumption. So preserving profits protects me against the downside disaster. And then watching for a resumption or a COTA 2 or a reentry allows me to take care of the upside. So I can still turbo and swing this one because it's easy to believe. Now, white and green is better than white and white because this thing was exceptional for a long period of time. White is not anywhere near as good. It's just been consistently good, but nothing special. Check or hold. White on strength and yellow on consistency means it was weak, but now it's good. What it just did was move from here, from below average to above average. It's not yet a leader, but it's moving up in the pack. That is a subtle change that you want to respect. The things that are below average now on the current strength, if it was below average and stays below average, it's weak now and it's consistently weak. Nothing. It's just it's barely hanging on. Not interesting. If it is yellow today, but it used to be red, it was bad, and now it's just weak. So it moved from disaster up into here. You know what that looks like? That looks like a catfish or a supported spring crossing, because this thing was horrible, harsh winter, consistently weak, and now it just got a little bit bad. I actually love this one. It was bad, and now it's just weak. There may be a chance to exploit new strength. So this thing looks like this: horrible, and now slightly better. This maybe this thing can come back to the mean, leg one. Maybe it can become above average, leg two. Maybe it could become a new leader, leg three. That's what happened with biotech. That's what happened with, where's PBW in this stack? I don't even see it in it, because this was just the top ones based on strength. But when you see things that oscillate, so the S&P does this, you see things that oscillate: great, horrible, great, horrible. What I like to do is get the ones that are very volatile, that used to be horrible and are now going to get slightly better. And then going from red, it used to be yellow and now is red. That's something that was that used to be yellow and has now dropped out of collapse. You know what I want to be on that one? Is I want to be short that one so bad, because I want to exploit the weak. It's already failing, and now it just is a complete disaster. This thing is a perfect short, and I'm going to sell on any failure. I'm looking for collapsing dragons on things that are red and yellow. And then red and red is something that I'm always going to be short, and that's going to be my first choice for intraday collapsing dragons. So what I do in my daily report then is show you a combination lens. This is a lens that supports monthly rebalancing based on strength. It gives you some swing trading ideas. It also gives you some turbo trading ideas on 30-minute charts and 3-minute charts. And the best ones are this one, are those two, and these two. Because they're failing, that makes collapsing dragons easy. This one is the SSC. This is the part2 buy on dips. This one is the emerging dragon, and this one is just winners win. So on a simple table, we can compare. We're looking at 300 ETFs, and we can make an entire meta strategy consisting of shorter term strategies of a different type. All you got to do is find out where on the curve you want to be. Winners winning are these guys. Green and white are these guys. White and green are these guys. Are they going to go up, or are they going to collapse? Red is this guy, collapsing. Yellow red is this guy. That's the SSC. It was horrible, and it's just starting. Yellow red is it just became the winter. Or red yellow, I mean. It just became, it was falling, and now he's in the winter below the zero line. This actually gives you, this very strongly correlates to the 4 seasons of MACD. Now, the 4 seasons of MACD uses the 10 period and 30 period regression line averages. This one is using that blended monthly rebalancing, the 13-week and 26-week. But the principles of how to look for different strategies based on fast and slow. And then I like to use system quality number as a separate indicator so that I can see where the real volatile, like, and now look at IBB is a biotech. That's the iShares NASDAQ. And then this one, XBI, is the S&P biotech. And so you can see that is a feature of biotech, the sector. And all other things being equal, if I'm going to trade biotech, I'm going to trade XBI because his strength and consistency are better than IBB, which is only above average. Check or hold. So when I look at this, another one that stands out for me is the small cap growth. IWO is green and white. That tells you it was good and now great. That means IWM, which covers, right? So if we take the Morningstar style box of value, blend, and growth, and large, medium, and small, the S&P has been great. Tech has been great. Large caps. IWM is getting better. The Russell 2000 index is pretty good. It just got better than the S&P. So there's money coming into the small caps to defeat the S&P. But you know what's even better is IWO is the growth element of the Russell 2000, and that thing is better than the broad. So what's that tell you? It tells you that the hottest sector is this one. Check or hold. And then the Russell 1000 growth index, IWF, is actually this. It's all of the growth elements of the large caps and mid caps. So growth is really good. And now the small caps are moving up faster than the other ones. That's all you really need to know. And IVW, the large cap growth index, is this one. So this one, and this one are crushing it, but the newest addition to it is this. And the small caps are better than the S&P. So I always like to find where's the S&P. You know, the other thing that's of interest? White and green. This is the banks. That's the equivalent of XLF. It's a little more volatile, but it used to be great. That 86 would usually put it up in here. But finance has started to decay, and on the strength basis, this thing is dropping. So KBE and finance are dropping. Now, it's dropping before XLF, but notice XLF has moved to the bottom of the stack. And the reason The reason for it is that KBE includes mid caps and small cap banks. So it turns out that large cap banks, you know who that is? That's JP Morgan. Large cap banks, XLF, is JP Morgan, Goldman Sachs. Those guys are doing okay, but the smaller regional banks are starting to decay. And that's where KRE becomes interesting. KRE is one of our 60 symbols that we do in the weekly and the daily hybrid swing trading. So all this one does on the weekly performance is give you like the top 30 based on strength. And then as you start seeing, so all green is easy, all white is easy to understand. But when they change, that's giving you important distinctions in the peloton, the leaders, the laggers, and then the peloton, plus and minus. So this is minus minus, this is minus, this is plus, this is plus plus. And the average score is your zero line. Now, if I go down to this part of the weekend report, those 2 pages give you the top, I think, about 50. I like DIA because it's conservative and the volatility is less and it is slower to turn. Here's why. Let me finish this thought and then I'll answer your question and then that'll be it. So I want you to start making notes on why you think I would trade DIA versus the Qs. Okay, so the first thing is this chart, this is the middle 2 page, this is 2 pages. These are the top 50 or so based on largest average volatility. These are by far the most liquid top 50. All right. And these are sorted by strength. So you get to see the easiest, most volatile, or the easiest, most liquid. And now you can see these are all the greens. These are all the whites. Here's where yellow picks up. So look, here's KRE. I told you about that one. White and green. That's regional banks starting to decay, and they are weaker than the large cap banks of XLF, which is way up in here. So you can see XLF, you can see the entire banking sector start to decay, and then the regional banks, which are smaller cap banks, are really starting to decay. And you can see that their volatility score is lower than the volatility score of the larger. So this is a weaken. Those 3 tell you that this is weakening of the financial sector, starting with the smaller caps, where the rubber meets the road. Check or hold. Now, on the second page of this is places where these things right here every week are no-brainers for collapsing dragons. Why? Because they're red and red. They're horrible now. They've been horrible for 10 weeks. And the ones that are triple reds, their volatility is so bad. Okay, what's that? Hong Kong, commodity blend, and China. China is absolutely the worst. You want to see how bad China is? Let's take a look at China on the 3 day. That's over the last uh, 30 days, 150 days, probably 300 days. It's gone from 33 all the way down to 21. That's minus 35%. Why would you ever short the US when China looks like that? If you're looking for shorts, you go to this report. And you find those. You know what just really got recently worse? Utilities are, they were bad and now they're horrible. Certain REITs were bad are now horrible. You know what's going to have a great dividend percentage? REITs. You know why? Because the price has been crushed and that drives dividend yield up. Is US real estate going to go to zero? No, it is not. Now is the time to be buying US real estate with large dividend payoffs. IYR, REM. FTSE mortgage REITs is like global real estate. So maybe you want to look at IYR instead. But this one page now gives you a ton of useful swing ideas. You get to see where they are compared to the 4 month moving average to give you a simple buy. If it's below the 4 month moving average, you get a sell. Everything that's crushing it is above its 4 month moving average. Most things are above their 4 month moving average. You know what's not above its 4 month moving average? All the dogs. These things make great collapsing dragons. And then if you want to look for volatility, you can just look at ATR percentage. That gives you, if I was going to use 2 times ATR, this tells me that about a 5% initial stop is going to give me 2 ATRs for anything so that's all I need is 5% initial stop. Now, you asked me about DIA versus Qs. In the volatility stack, you realize that the most dangerous things change first, and then the safer things react later to fear. All right. When fear happens, when fear enters the marketplace, the things that are in the most dangerous position react first. Check or hold. So there is a life cycle of things. You want the canary in the coal mine. You want the early warning that things are getting potentially worse. So the S&P, DIA, the Qs, the US small caps, VXX, this is volatility itself. That is the most volatile instrument because it's volatility. As soon as fear enters the marketplace, VXX explodes. The next most volatile thing is IWW or IWM, the small caps, then the Nasdaq, then the S&P, and then DIA. So in terms of the sequence of reacting to fear, the last thing that reacts to fear is DIA. The Qs react to fear sooner. So one of the things that I can do is I can engineer a very tight stop. Like if DIA is going up, it takes a lot of substantial, genuine, justified fear to make DIA collapse. So that means that I can afford to have a very tight stop on DIA. Like in DIA, I can use 2 cents, which is equal to $10 on the mini contract. So I can engineer a very large position size. And what I can do is I can watch, hey, if everything is sideways or sideways quiet channel or absolutely quiet and going up, the first thing that's going to change is VIX collapses, then the Russell gets nervous, then the Qs get nervous, and then the S&P gets nervous. If all of those things have started to roll over, DIA has probably gone up and then gets sideways, and now I have plenty of time to get out of it without suffering a catastrophic loss. Why? Because those are 30 mega caps. It takes a lot of fear to make DIA budge, whereas a couple guys in Chicago that are leveraged to the max can get afraid and bail, and that makes VXX. So I like to watch volatility infect to the right, and I can trade DIA safely because it's protected by how thick its skin is. This is like the ultimate weapon in terms of a big fat hippopotamus or a great big cow that doesn't want to run. You can, these are like little rabbits and field mice that are running at the first sign of danger. So I can use that as an early warning to make sure that I am protecting open profits in DIA. Also, when everything is going down together, what's the first thing that turns? Positive volatility, small caps, tech, SPY, and then DIA is slower to change. So at the turning points, when all of these things are hitting an SSC, I can now stock DIA with a very small risk to catch the turn in DIA. That's why I trade DIA. And plus, in the mini contract, 1 penny in DIA cost $5. 1 penny in the S&P is $10. So you can engineer a very nice managed position in the futures in the YM contract. That's where I trade with leverage. All right. That's everything I got. I'm going to brunch with my best girl, and I wanted you guys to see those basic ideas about the longer term markets. This actually gives you a way now to do market classification with this chart. Now what I have is the regional summary. I have 4 US and 6 globals. Each one gets measured by price relative to the 4-month moving average. And if each one of these is above its moving average, it gets a buy signal, and then the total of that column tells you this week what your risk exposure is based on 10 sensors in the US and the global markets. Then I can go to the strength column and say, the tech is great and it's better than the small caps, which are better than the S&P, which are better than the mid caps. So that's the US indexes. And then of all those 10, the two strongest are US tech and small caps. The weakest are emerging markets and Asia less Japan. But tech is the only one that's extraordinary big. And then if I go to the S&P Spider Extract, I can compare SPY to the 9 elements of the sector spiders. And right now, finance and tech are great. Industrials are good. Healthcare and discretionary are good. Utilities are horrible. And then staples, energy, and materials are bad. Then I can come down to the broad asset class, and I can say the S&P is the best choice from among treasuries, U.S. real estate, blended commodities, gold for precious metals, and oil. Blended commodities are getting murdered. Everything else is below average. Only U.S. equities are above average. So the equity markets are pretty good. Then this is all of the U.S. This is the European 350. This is Asia, consisting of Japan and Asia less Japan, because Japan is so huge. Then these are the countries of Asia. These are the countries of Europe. This is the Western Hemisphere. This is the regional Latin American emerging markets. And then these are the other asset classes. These commodities, 20, are those commodities, DBC, the blended commodities. These are the 9 ETFs that represent the U.S. market. Large caps, diamonds, S&P, tech. Mid caps is MDY across the board, IJR across the board, and then the subsets. So this one table gives you a weekly update of the entire world market model down to a useful level of granularity using the blended monthly rebalancing and ETF2 measuring sticks. That's the best market classification strategy that you'll find. That gives you actionable information. Compare that to what Van used to produce with the rolling SQN. There was absolutely no actionable information in that whatsoever. This one gives you actionable information for short-term and long-term swing trading in a way that is useful. And that's everything that I want to say on this. You guys take good care. We'll get this published and posted. And you can ask questions about this in the future, but think your way through all the stuff that I covered here. Okay? Take good care.
Great. Thank you. Enjoy your brunch.
Thank you.